Hold on. All right. Good afternoon, everyone. I'm Carla Zevnik-Seifzer with ClearStep Financial, and I would like to welcome you to our Market Outlook presentation today. I know there's a lot of uncertainty out there in the world, as always. So our goal at ClearStep Financial is to help educate and guide our clients through our ever-changing financial world. To help us accomplish this goal today, I'm pleased to introduce to you our guest speaker, Dan Blong, Vice President with First Trust Portfolios, a nationally respected financial firm. Dan is a graduate of the University of Illinois in Chicago, where he received a Bachelor of Science degree in finance. And Dan joined First Trust in 2005 and currently holds Series 7, 66 securities licenses. And I believe you will find his presentation both educational and informative. So with that, go ahead, Dan. And any questions at the very end, Dave will cover questions at the very end. So thank you.
Okay, thank you, Carla, and thank you, everybody, for joining us for today's call on a nice, bitterly cold Wednesday here in Wisconsin.
Dan, it's
what I wanted to do.
Dan, if I can interrupt, I'm sorry, it's a little muffled. The voice, your voice coming across, it's just a little muffled.
How's that? Is this any better?
Oh my goodness. Great. Thank you.
Perfect. Okay. Well, thanks again for everybody dialing onto the call, and hopefully you're calling from your own warm houses today in cold Wisconsin. So what I thought I'd do is just give a little bit of a recap of 2025, very little bit, and then turn our attention to expectations and what our outlook is for 2026, because 2025, we all lived through it. It's like seeing a movie, and at the end of the movie, before you leave, can you stick around and review the movie? It's like, well, I just saw the movie. But here's just a quick take, and this is going to come from our Chief Investment Officer at First Trust, Dave McGarrell. So in 2025, the S&P 500 index continued its march higher with a third consecutive double-digit return, approximately 17.9%. Despite us having a massive correction, if you do recall, back in April 2025, we saw the index go lower by as much as 15% in a month. Later went on to rally. But the headlines undoubtedly last year were all about tariffs, Liberation Day, artificial intelligence. I think that's continued to be the story. I'm sure we'll have some questions on AI today. But the real story for us was always what drives market returns. And it's one word, starts with an E, it's earnings. And so we saw earnings for the index in 2025 to have grown almost 13% for the year after companies report their fourth quarter results later on this quarter. More importantly, earnings projections as we look into 2026 are expected to grow over 15% for the index. So last year's exceptional returns were the result of this profit growth and continued multiple expansion. So let's just jump off from there. Brian Westbury is the chief economist at First Trust. His most read and most shared piece is what's displayed on the screen. It's called the Monday Morning Outlook. Feel free to ask Carla or Dave if you'd like to receive this. It's typically written in just one page and a summary of what's going on in the economy. So at the beginning of each year, Brian's asked, like many other chief economists, to provide their forecast or projections for different data points throughout the year. And the first one we see is S&P 500 6,000. So it's if you're familiar with where the S&P is trading at today, it's above 6,000. So in his vantage point, he's showing that the S&P 500 is slightly overvalued. And what makes it overvalued or undervalued? Well, the same thing that we've been looking at for decades. Corporate profits, we look at the 10-year Treasury note, and we just say, is the market overvalued or undervalued? By the way, this is not a trading tool. It's not meant to be a trading tool. It does not mean get out of the market because we think the markets or the S&P 500 is overvalued. So two things can be true at the same time. One, we can view the S&P 500 as being overvalued, and two, we can still remain bullish on equities. There's a lot of equities and different stocks out there. What I wanted to flip to the next page here is this is compiling not just Brian Westbury, but I think it's over 20 different economic forecasts for the calendar year. And so on the very bottom right, let's see if I can draw on the screen here. No, it's not. Let me draw. But if you look at the very bottom right, 2026, the highest projection for the given year is 8,100 on the S&P, the lowest 6,000, and the average about 7,400, which on the chart to the right shows approximately about an 8.5% return. So after, as I mentioned, 3 double-digit years in the S&P 500, we just have a little bit more muted expectations or normalized expectations going into 2026. One thing to note on this, though, is if you look at the past 10 years prior, the average projection of the S&P 500 versus the actual return, you can see there's been years where forecasters are pretty close. But there's years like 2024, 2023, 2022, where their forecasts were off by 18, 22, 23%. So at the end of the day, and our team would admittedly say this as well, we don't know how the year is going to unfold. We don't know what's going to impact the markets, how many interest rate cuts there may be potentially this year, what's going to happen in the midterm elections next year, any geopolitical risks that take place. So it's a moving target. So let's unpack a little bit more about the market and what we're looking at today. So if you're looking at the screen, this is the S&P 500 index forward price to earnings. So if you look at the middle gray line, again, I'm sorry I can't draw on this chart, but the average going back the past 30 years has been roughly the S&P trading around 17 times earnings. You can see 17 and change. So the orange line below is when we're trading at a deep discount. So think of time periods like 08, 09. The S&P was trading at less than or just north of 10 times earnings. Again, in 2011, 12. And then we've had a nice long decade of market returns. We got above the historical average in green back during COVID for an elevated period of time. And now we're trading at about 22 times earnings. So one of the things that we have at First Trust is that it's hard to see outsized gains at these starting prices. And again, that's just for the S&P 500. One of the things that we've been mentioning to our clientele is that if you look at the market breadth, and breadth is measured by what percentage of companies in the S&P 500 index have outperformed the benchmark itself. So for just a plain example, if the S&P 500 index was up 10%, how many of the 500 plus constituents were above 10% for their return? And so when you see the orange charts, that means it's been a very narrow market, narrow breadth of the market. Few companies have really driven the performance of the index. And that's what we're coming out of. 23, 24, 25, only 2022 where 57%, we saw larger than 50% of the names contribute. That was a rotation out of tech and energy. But really for the last 7 to 8 years, it's been a narrow market. And really the last 3, it's been extremely narrow. If you want to go back in time and kind of look at when this rivals, well, think about the dot-com era. So 1997, 1998, 1999, when any company that was IPOing had the word .com behind it, technology was dominating the index, was dominating performance. We saw the breadth of the market get extremely narrow in 98, 99. Only 29 and 31% of the constituents were beating the index, or really just a narrow number of names were contributing to the overall index performance. So we like to say history doesn't repeat, but it rather rhymes. Here we are in 3 consecutive years of 27, 28, and 30% market breadth, or again, a very concentrated market. We've talked about the Mag 7, or you've heard about the Magnificent 7. Our expectations is we would expect at some point here, and it's looking like it's taking shape so far here early in January, for the market to broaden out, get wider in the constituents that are contributing to the performance. And we mentioned earnings on the beginning of the call. We're going to talk about those earnings again as we move forward and where they might be coming from. So let's start on the whole. S&P 500 EPS is earnings per share of the index. In 2005, roughly $269 of earnings. As we move forward, again, expectation for 2026 is for earnings to continue to grow, which is a good thing. Stocks historically follow earnings. And it looks like from 05 to 06, I'm sorry, 25 to 26, that's about a 15% earnings per share growth in the S&P 500. But what matters at the end of the day is what price we pay for stocks. So stay with me on this chart, because this is pretty important. This is kind of a microcosm of what we've seen, where the performance has come from and where we think it's going to start to shift to. So we broke down the S&P 500 into those magnificent 7 stocks. And if you're not familiar with the Mag 7, that's going to be Apple, Microsoft, NVIDIA, Google or Alphabet, Amazon, Meta or Facebook, and Tesla. So those are the 7 names, the 7 darlings, if you will, over the past 5-6 years. And not surprisingly, it's because we've seen their earnings growth grow dramatically. And so their share price or multiple expansion has grown dramatically with it. But what we're starting to look at, if you look at 2025, 2026, and 2027, we're coming into a period where we're seeing not 20% earnings growth like we are for the Mag 7, but rather 13% or double-digit earnings growth in 26, double-digit earnings growth at 27. And more importantly, a lot of those names in the 493 are not trading at expensive prices or expensive multiples. This chart really brings it home. I'm going to kind of simplify this. So this orange line with these data points going across left to right are the weight in the index. So if you're not familiar with the S&P 500 index, it's not an equal weighted index. It's a market cap weighted index, which means the bigger the size company, the bigger weight they will have in the S&P 500 index. So although there's about 500 to 503 constituents or names, you can see the top 10 names, those Mag 7 plus Broadcom, Eli Lilly, and Berkshire, today, or I'm sorry, at the end of 12/31/2025, those 10 names represented about 40% of the index. In other words, if you were to invest just in the S&P 500 index fund, for every dollar you invest, 40 cents of every dollar is going to name those 10 or going to work in those 10 stocks. And those 10 stocks today trade at approximately 30 times earnings, well above the S&P historical average of around 17 and change. And as you go down the food chain, the next 11 through 50, in which, you know, I think most of us on the call, if I were to put up those names of companies, number 11 through 50, you find names like Costco and Walmart and CVS and Walgreens and Coca-Cola, a lot of recognizable names, but they dropped from trading at 30 times earnings to around 20 times earnings, maybe slightly more expensive than historical average, but not nearly as expensive as we see in the top 10. And so one thing to note is if you looked at the top 10 performing stocks in 2025, 7 of 10 of them came outside the top 100 names. Again, 7 out of the 10 top performing stocks in 2025 were outside the top 100 names. And if you look at this orange line, as you get to the stocks number 100 through 200, 200 through 300, 300 through 400, and 400 through 500, the weight that they have on that index drops dramatically. So the takeaway is owning strategies that maybe look at the S&P 500 and screen for stock selection factors versus, you know, looking at other things outside of just market cap weight. So I mentioned those 10 names. Here they are on the screen again. This chart is as of 12/31/25. So those are your top 10 names in the S&P 500 by weight. So right now, NVIDIA, you're the biggest company in the world. You have a 7.8% weight, followed by Apple, Microsoft, both in the 6% range. Google at 5%, and then you can see on down the line. And to the right of that, you can see what their forward price to earnings are. And right now, looking at the S&P 500, the average is about 23 times earnings. So again, Brian Westbury, Chief Economist of First Trust, looking at the S&P 500 saying, hey, you know what? It looks like from our vantage point, our models, that it's overvalued. But again, there's a lot more names to consider. So I love looking at just the largest U.S. companies by market cap by decade. So we just spent time looking at the 2025 top 10 names. This just gives you a sense of history. So let's just look at two other time periods or two other decades. If I could have your eyes screen to the middle of the chart, the year 2000. So back in 2000, the top 10 largest names in the S&P 500 were Microsoft, okay, that you're still around. So I think 1 out of the 10 names is still in the top 10. Number 2 largest company in the world was General Electric. I think a lot of us are familiar with GE. But beyond that was Cisco, Walmart. You guys are still around. Intel, you've really been struggling. NVIDIA has taken over as a leader there. Lucent Technologies, 6th largest company in the year 2000. Beautiful, shiny glass building in Naperville, Illinois, where I used to live. No longer a company, followed by other companies in there. Citigroup, AOL, Time Warner. It's like, man, would I have wanted to put 40 cents of every dollar into those 10 names at that time period? I don't think so. Even better yet, look at the starting of this chart, 1980. If you look at the top 10 names in the S&P 500 in 1980, there's a certain sector that I think is very, very prevalent that's not very prevalent today. Right now, we're dominated by tech as the biggest weighting in the S&P 500. Back in 1980, it looks like, if I'm counting them, Exxon, BP, Mobil, Chevron, Texaco. I think there's 6 out of the 10 companies are in the energy business. So it's just interesting how over the decades, the darlings of the top 10 names oftentimes do start to change out. So this is a regression chart. Just looking at data points, when we're starting the S&P 500 at a PE north of 22 times earnings, all those different dots that you see scattered out there are the different calendar year returns. And then the dotted line with the orange level saying current level 7.26%, that's been the average. So we're just taking the starting level of the S&P 500 at about 22 times earnings, going back to 1991. What are some different dot plots we can see based off of the analysis at that starting level? It gets a little busy here, but again, looking at average a mid single digit return here in the S&P. And then we're going to wrap up here in short order, and I'll take questions from Dave. I wanted to turn the attention to small caps. So I began a conversation talking about the S&P 500 and earnings growth. So if we look at the cumulative return for the index over the last 3 calendar years for the S&P has been roughly 86%. And earnings growth during those years dominated by large cap stocks. In fact, it was hard to find it anywhere else. So earnings growth for the index increased 20% from the end of 2022 to the end of 25. Whereas if you look at the mid-cap 400 index, over that time frame, 22 to 25, it saw an earnings decline of 7%. And if you looked at the small cap 600 index, it saw an earnings decline from 2022 to 2025 of over 10% for those 3 years. So basically, the takeaway has been, looking back, the returns for small and mid-cap indexes, along with international, has lagged the index over the past 3 years. So the opportunity for 2026, in our view, is that earnings growth is finally expected to show up in places other than large cap stocks. There's double-digit earnings growth is expected in the small, mid-cap, and international indices. So while the profit growth story is intact for large caps, as we start the new year, further multiple expansion or prices going much higher is much less of a certainty, as they are already highly valued historically. The more profitable opportunity for equity investors may well be in those laggards over the past 3 years, and those multiples for the earnings is significantly discounted to the index. So basically, if we look at earnings expectations for small caps at current prices, I mentioned large cap earnings are expected to grow by about 15%. The forward price to earning ratio is about 22 times earnings. For the small cap 600 index, earnings are expected to grow 16%, but trading that at 22 times earnings, but only at 14. So one takeaway for small cap is this is looking at the Russell 2000, which is a benchmark index for 2,000 names that represent small cap, the good, bad, the ugly. One thing we're noting here is that there's a larger than normal level of companies that are unprofitable, percentage of firms that lose money. It's about 44%. Now, if you've been around long enough, you've seen companies that have been unprofitable that turn out to be great companies like Amazon. but we're a little concerned that when we buy small caps, we don't want to buy the Russell 2000 index that has, some great quality names, some names that are unprofitable. We want to screen that out. And one of the reasons we want to screen it out is if we look at the debt maturity range for the Russell 2000 index over the next 4 to 5 years, about 2/3 of the company's debt is going to mature. And we're no longer at 0.1% interest rate. So when we have a combination of some great names in small cap, but there's some names in there that are unprofitable that have more debt maturing, that's more of a reason in our view that you want to look for strategies that screen for different stock selection factors rather than just buying the indice in small cap. And I think this will be, I'm going to have 2 more charts, I think 2 or 3 more charts left, Dave, if you want to get ready for questions. Something that I'm sure is going to be on everybody's mind, just kind of pivoting out of large cap and small cap for a second and just talking about the reindustrialization of America. Here in Wisconsin, we all know the data center demand is powerful up in Sheboygan County and down in Racine County. So the demand for electricity needed to power data centers is projected to rise significantly over the next 7 years towards the end of the decade. And so also the global demand for data center capacity is expected to see compound annual growth of over 27% between now and the end of the decade. So one area that we talk about, artificial intelligence. Yes, it's great. It's uplifting lives and improving many different sectors of the economy. But one of the beneficiaries of all this capital expenditure from a lot of these mega cap growth names is not necessarily, looking for the hope of future profits by investing a lot in AI or data centers. But some of the beneficiaries that we see immediately take advantage of it are the companies that are part of the reindustrialization of America. So looking at outside sectors like industrials, materials, energy-related companies, as the demand, both domestic and abroad, for data centers increase, well, again, beneficiaries may not just be the technology companies, but some of the industrial-based companies that are in ball bearings and sheet metal and HVAC. And those are areas that, companies that tend to be outside the S&P 500. And the last thing I just wanted to leave you with, and I can open up to questions, is I mentioned that small mid caps have lagged the past 3 years. International as a index has lagged the U.S. over the past 15 years. For the first time in a long time, last year we saw international be a positive diversifier into clients' models. So from a valuation standpoint, yeah, we had an uptick last year, but we're still trading well below historical averages when we look at the international PE discount versus U.S. Much the same with small caps, whether you're looking at the Russell 2000 index, or in this case, we call it the All Country World ex-US index. There's a lot of good names. There's a lot of bad names. We would say that if you're looking at owning international stocks, employ strategies that have a filtering process. And one of my this would be a rhetorical trivia question, but as you look at this chart and you hear me say that international has lagged the S&P for a considerable amount of time, and we know that the U.S. Dominates the world, and when it comes to technology companies, my question is, over the past, call it since 2001, 20 some years, if you look at the All Country World Index, so that includes the U.S. and the world, out of the top 50 stocks each year, what percent do you think were domiciled outside the U.S.? Again, looking at the past 24 years, top 50 performing stocks in the world, what percent do you think were derived outside or domiciled outside the U.S.? It's kind of leading the question here, but really orange is the foreign, U.S. is the blue. And if you read the top gray box here, some of the best companies in the world are located outside the U.S. since 2001. On average, around 81% of the best performing stocks in the All Country World Index were from non-U.S. companies, as shown in the chart below. So yes, does the U.S. have a stranglehold on technology? Absolutely. But there's some really good companies outside the U.S. market that, as an asset manager, our job is to find. And you think about Taiwan Semiconductor, chip maker out of Taiwan. You think about Ozempic from Novo Nordisk, European company. When you think about Europe, you don't necessarily think about technology or Silicon Valley. You think about, high fashion and fast cars. Rolls Royce come to mind. So anyways, I guess our takeaway is, at the end of the day, we know the long term, the market has a bias to going up. We know there's periods of time that we pay for that volatility. But if we look at historical index going back to 1926, overwhelmingly, we see a lot more green than red. I'm sorry, 1928. Historically, the S&P has averaged around a 10% return, 10 and change, but very seldom does the calendar year return finish between that 10 and 11% marker. Periods where we're up the past 3 year double digits in the mid 20s, 18. Periods where we have negative. But at the end of the day, we know that long term, the stock market is basically a place that volatility is the price we pay for long-term stock market returns. All right, we're coming up at the 12:30. Let me pause there, Carla and Dave, and see if I can address any questions or share any more insight at some point.
Okay, thanks, Dan. We greatly appreciate all that information. It was very informative, and thank you for sharing that with us. Good talking points, right? These are conversations you can have with your neighbor and sound pretty intelligent. So thank you. Does anyone have any questions? You can either go in the chat or you could unmute yourself and then ask a question for Dan. This would be a good time. Or if you have a specific question, you could reach out to your financial advisor here at ClearStep as well. And then we could answer questions for you as well if it's a personal question. So do you have any questions about the material or anything regarding the market that Dan had shared today? Dan, I think we're all set.
Well, it's one of those things. I know this is a retail client event, and my day job is working with the financial advisor. So to a large extent, many folks may not care all the details I shared today, and that's great because they don't need to. They can enjoy their lives, their kids, their grandkids, and it's our job to care about this stuff and make sure that their plan is aligned with their long-term goals. And happy to just basically say what Carla and the team does at the financial advisors. As your life unfolds, your plan evolves, and it's their job to and my job to work alongside them, get the devil in the details, and identify where the next opportunities are at. So thank you for your time. I'll stick around just in case there's any last minute questions.
Okay, thanks, Dan. We appreciate it. Frank, did you have a question?
Yeah, if I may. As a former history teacher, I'm concerned about the impact of tariffs and the weaponization of tariffs back in the late 1920s. Do you see any link with the current use of tariffs as a motivator or a weapon or whatever? So I'd just be curious about your take on tariffs today.
Yeah, good question, and I'll try to give you as much content as I can, hearing from our thought leadership at First Trust, including our chief economist, chief investment officer. Obviously, generally speaking, free trade is the best route. With tariffs today or the past few years, they dominated the talk. And if you've noticed from the lens of an investor, okay. From the lens of an investor, that's what we try to communicate for, is the investor lens. It really hasn't had very much impact. You can talk about in terms of overall market performance. One of the things that we say at First Trust, or that some of us say at First Trust, is give it 72 hours. Oftentimes, tariffs are used as a tactic, and we spend more time being concerned about it. By the time it comes into fruition, it's already taken off. And you can look back to last year with Mexico and some of the other countries that were out there. So overall, we haven't, and I'll see if I can reference a chart that our economic team has produced. I know that this has been a common question through client events throughout the year, and I'll share it with Carla. But I do know that they have illustrated, just the overall impact of tariffs on the market has been very, very muted in terms of the actual return impact. Companies matter. They're going to deal with tariffs, and before they get to the end user client like you and myself. And obviously, we all have personal examples where it's impacted somebody or an industry that's more close to home. But again, big picture, it's had very little impact so far, knock on wood.
Oh, good to hear. Thank you.
Yes, sir.
All right. Thanks, Frank. Thanks, Dan. I think we are all set.